and gentlemen, and members of the press. The Monetary Policy Committee met on the 23rd and 24th of March 2015 against the backdrop of harsh external economic environment and significant risks in the domestic economy. In attendance were 11 out of the 12 members, including Dr. O.J. Nana, who resumed duty as Deputy Governor of Financial System Stability at the end of January 2015. The committee analyzed key developments in the global and domestic economic and financial conditions, as well as the outlook for the rest of 2015. The committee noted that the pace of global economic recovery had remained moderate and uneven. In particular, the committee noted that lower commodity prices were weighing heavily on output growth, especially in the oil exporting countries. In addition, expectations of a rise in U.S. short-term interest rates continue to fuel capital outflows and currency weaknesses in the emerging markets and developing countries. Against the backdrop of sustained weakness in the Eurozone and softening growth in the emerging markets, global output has remained largely tapered. During the first quarter of 2015, the United States led the global impetus to output growth as consumer demand strengthened on the heels of falling oil prices, lower U.S. oil imports, and accommodative monetary policy. In contrast, in the Euro area, continued output decline in the face of the positive oil price shocks made European central banks to introduce a massive 1.1 trillion assets purchase program commencing in March 2015, involving a 60 billion euro monthly assets purchase. The program, although open-ended, is expected to last at least until September 2016, by which time inflation may have gained reasonable traction. The committee, however, noted a number of important downside risks to global output in 2015, including geopolitical tensions and conflicts, the negative impact of commodity price declines, weak external demand, and the possibility of monetary policy normalization in the U.S. Growth could, however, remain subdued in most of the Euro area and Japan in the short to medium term. Growth in the emerging markets may exhibit wide variations with sharp decelerations in most of the large emerging market economies, especially in Latin America and Eastern Europe, due to the headwinds from softening commodity prices and slowdown in external demand from the advanced economies. In addition, country-specific risks such as political crisis, structural factors, adverse weather conditions, and large swings in currencies may continue to slow aggregate demand in a number of countries. Global inflation continues to be low due to declining oil prices and continued slack in global output. Core inflation has continued to sag due, among other things, to the dampening effect of low oil prices and lack of appreciable wage gains. Average inflation for the developed economies is projected to remain flat at 1.5% in 2015 due to the increasing output gap, weak recovery, and slow regional currencies. This development appears to be offsetting the risk of imported inflation in the emerging and developing countries, most of which have experienced moderate to severe depreciation in their local currencies. Developing economies are thus expected to have moderate inflation in the medium term. The committee observed that the outlook for global monetary policy suggested a predominantly easy stance. In the Euro area and Japan are expected to remain in the accommodative mode. Even in countries where growth appears to be strengthening, like the US, UK, and Canada, there are indications of delayed switch to tight monetary policy stance. Owing to currency concerns, however, the committee further noted that some emerging and developing economies may experience moderate tightening in the short to medium term. Growth in sub-Saharan Africa is projected to average 4.9% in 2015. The domestic economic and financial development. The National Bureau of Statistics estimated real gross domestic product (GDP) growth rate at 5.94% in Q4 of 2014, lower than 6.77% recorded in the corresponding period of 2013 and 6.23% recorded during the Q3 of 2014. The committee noted that the slowdown in growth resulted mainly from the non-oil sector, which grew by 6.44% in Q4 of 2014, compared with 8.78% in Q3 of 2014. Agriculture, industry, construction, trade, and services contributed 0.89, 1.3, 3.64, 0.87, and 2.45% points, compared with 1.21, 1.04, 0.36, 1.08, and 2.53% points respectively during the third quarter of 2014. The softening non-oil GDP was partly traced to the spillover effects of low oil prices, which negatively impacted agricultural output, trade, and services. Oil GDP, on the other hand, grew by 1.18% during the fourth quarter of 2014, compared with a decline of 3.60% in the preceding quarter. The growth in oil GDP is particularly noteworthy because it came at a time when the sector was experiencing external negative price shocks. Headline inflation remained within 6.0 to 9% band estimated by the CBN. However, the committee noted with concern the gradual increase in the year-on-year headline inflation during the first 2 months of the year, from 8% in December 2014 to 8.2% in January, and further to 8.4% in February 2015. The underlying inflationary pressures came largely from food, particularly imported food and the core components. Food inflation rose from 9.2% in December 2014 to 9.4% in February 2015, while core inflation increased from 6.2% to 7% during the same period. The major risks to inflation, the core committee noted, include elevated aggregate spending in the run-up to the 2015 general elections, the likely higher import prices on the strength of an appreciating dollar, and possible food supply shocks linked to insurgency and insecurity in some major agricultural zones of the country. Broad money supply declined by 1.7% in February 2014 over the level at the end of December 2014. This translated to an annualized decline of 10.23% compared with the provisional growth benchmark of 15.24 for fiscal year 2015. The decline in M2 primarily reflected the contraction of 18.14 and 8.22% in net foreign assets and other assets, respectively, during the period. The fall in the net foreign assets is attributed to the combined effects of weakened oil price and reversal of portfolio flows. During the period, net domestic credit grew by 9.89% in February 2015, annualized to a growth rate of 59.31%, compared with a growth rate of 7.89% recorded in the corresponding period of 2014 and an indicative benchmark of 29.3% for 2015. The credit to government component grew sharply by 54.69% relative to a decline of 21.81% at the end of December 2014. The committee noted that money market rates were relatively volatile in the intervening period. They stabilized on average during the first 2 months of 2015 as banking system liquidity fluctuated. First, average interbank call and open buyback rates, which opened at 10.58 and 10.52% on the 5th and the 6th of January 2015, closed at 11% and 9.23% respectively on February 27, 2015. Average interbank call and open buyback rates for the period were 15.21 and 18.36% respectively. The committee observed that the bearish conditions in the capital market continued in the review period. The all-share index decreased by 13.1% from 34,657.15 at the end of December 2014 to 30,103.81 by February 27, 2015. Market capitalization also moved in the same direction, falling by 12.5% from 11.48 trillion to 10.04 trillion during the period. The committee noted that the situation, though reflecting current trends globally, needed to be monitored closely. The external sector development. Following the closure of the official retail Dutch auction system window of the foreign exchange market on the 18th of February 2015, the foreign exchange market is now unified. Consequently, the Naira exchange rate opened at 180 Naira to the dollar and closed at 198 Naira to the dollar, with a daily average rate of 198 Naira to the dollar. This represented a depreciation of 17 Naira 9 kobo, or 9.04% for the period. Committee consideration. The committee expressed satisfaction with the impact of the decisions taken to harmonize the foreign exchange market. As a consequence of those actions, the interbank exchange rate has stabilized after an initial adjustment. The committee, however, expressed concern about the wide divergence between the interbank and the bureau de change market rates, which provides an avenue for arbitrage and speculative activities in the market. Committee noted with concern the phenomenon of currency substitution and partial dollarization in the economy, a development which may significantly fuel the high demand for foreign exchange. The committee therefore reiterated that the Naira remained the currency of transaction in Nigeria and the economy, and advised the bank to take all possible measures to address this development. The committee also expressed concern about the outlook for growth, which had moderated partly due to the effects of low oil prices, Naira exchange rate depreciation, and election-related concerns. The committee was, however, optimistic that the situation would improve once elections were successfully conducted, with the expected improvements in business confidence. Committee took note that while adverse developments in the international oil prices had affected government revenues and reserves creation and impacted negatively on capital flows, the financial system remained stable, with key banking stability indicators showing robustness. In light of this, the committee directed the bank to take all necessary measures to improve the resilience of the financial system, as well as the overall economic environment and functioning of the financial market. The committee also took note of the administrative measures implemented by the bank since the last meeting of the Monetary Policy Committee to achieve stability in the foreign exchange market. The bank had, on the 18th of February 2015, taken the bold supply management measures to close the official window of the foreign exchange market in order to create transparency and minimize arbitrage opportunities in the foreign exchange market. However, to deepen the market and enhance the efficacy of the demand management measures, the bank gave specific directives on the effective monitoring of repatriation of both oil and non-oil export proceeds. In addition, the utilization of export proceeds has been restricted to eligible transactions only to minimize leakages. The committee enjoined the bank to continue to fine-tune demand management measures as well as implement appropriate supply enhancing strategies to ensure effective demand and utilization of foreign exchange in the country. The committee noted the gradual rise in headline inflation, driven mainly by exchange rate-induced high prices of imported food and output supply shocks. However, the committee was of the view that the prevailing tight monetary policy stance and some of the recent administrative measures would, among others, help to lock in inflation expectations and further stabilize the Naira exchange rate. In the light of the foregoing, the committee observed that its previous decisions needed time for their effects to fully permeate the economy and therefore voted to maintain the current position. Consequently, the committee decided as follows. All 11 members unanimously voted to retain the monetary policy rate at 13%, retain the CRR on private sector deposits at 20%, retain CRR on public sector deposits at 75%, and retain the liquidity ratio at 30%. I thank you all for listening.
Distinguished ladies and gentlemen, you heard the presentation of the communique by the governor. If you have any questions or comments, you just step by here, announce your name, the institution you work for, and then please limit your questions and comments to the subject matter of the presentation. Thank you.
Good afternoon, Mr. Governor. My name is Elijah Balagu. I work for Field Directions. I have a couple of questions, very short questions. Investors have talked a little bit about the CBN sort of prioritizes the sale of foreign exchange in the private market to foreign portfolio investors. I just want to ask if this is correct. And also, are you in contact with JP Morgan about Nigeria's inclusion in the GFBI indexes? And how optimistic are you that the decision will be favorable to Nigeria? And would you have an idea of when the announcement will be made?
Thank you. Any other one? Okay, Nancy.
Good afternoon, Mr. Governor. I'm Nancy. I am for the motion AIT. Governor, I would want to ask you about the Naira outlook moving forward, because there's still that wide band between the interbank market now and the FX market. Of course, the Naira is going like today 220 to 222 at the parallel markets. How does the central bank intend to lessen that gap? Then what is the interest rates outlook post-election? Of course, the elections, Godwin, will take place on Saturday. What do we hope to see? Will the central bank still be hawkish? And the third question, the health of the foreign exchange reserves. We do know that the drop of oil prices has really hurt our revenue base. $30 billion so far. How does the central bank intend, of course, to make this perhaps more robust? Are you in talks with the fiscal authorities on ways to actually improve this? Then going back to the interest rate again, I want you to tie it, especially with the launch of the Development Bank of Nigeria yesterday. Of course, we were there at the launch. How will banks, commercial banks like DNBs, work with even those lending institutions, so to speak, because it seems that the federal government is launching a bank for every sector now, of course, to ameliorate poverty. How do you intend to achieve that?
That's the mouthful. I think that just gave up all the questions.
Let me ask questions. They have more questions, please.
Any more questions?
Okay, yeah, thanks. Yeah, Bloomberg talks about the fact that CBN prioritizes sale of FX to foreign investors. Well, there's nothing like prioritizing sales to foreign investors. CBN sells foreign exchange through intervention on a daily basis or as it deems fit, sell foreign exchange to people who have effective demand. But what we have done consistently to make sure that, yes, for the foreign investors, that we have made a promise to them that it is a free entry and free exit market. That whenever, if they do decide to come in to invest in Nigeria, and whenever they do decide that they want out of the market, that they should be unhindered. There should be unhindered access for them for foreign exchange so they can exit when they do decide to exit. We've tried as much as possible, and I know that all the demand coming from foreign investors have been met. And but I don't think that really amounts to prioritizing. It's just that we want to make sure that they are happy because of the promise that was made at the time of the investing in the country. You see, getting in touch with JP Morgan, let me continue to repeat myself that Central Bank of Nigeria remains committed to remaining on the JP Morgan index. The JP Morgan index has already told us what we need to do, and that is that we need to deepen the market, increase the level of transparency and liquidity in the market. We do not have to meet with them or talk with them once they have made it clear the criteria on us to meet. We've done, and there has been a lot of liquidity injected, and we believe the market is deep today. They said that yes, most of the demand, all the demand are effective after the introduction of the order-based two-way quotes, and we believe the size of the liquidity market is strong and can meet the size of supply in the market is strong and can meet all the demand that we have in the market. In the area of transparency, indeed, part of transparency is the closure of the official foreign exchange market, where we did that to remove the rent-seeking activities, arbitrage activities, or opportunities for people who felt they wanted to take advantage of the vulnerabilities in the foreign exchange market. And we took that bold move, and I'm happy that we did that, and it's a statement that we are transparent in our dealings. All foreign exchange transactions are transacted today in the interbank are recorded on the Reuters terminal for the world to see. And that's what we have done, and we believe that with these actions that have been taken, the JP Morgan index will, in due course, remove Nigeria from the watch list. Naira outlook going forward. Well, Nancy, you talked about the fact that exchange rate at the Bureau de Change segment of the market is 222.21. I'd like to say that that remains a shallow market compared to the interbank market. In terms of percentage in the foreign exchange market, it is, in my view, very insignificant, and that market deals mainly in transactions that are not documented. And for that reason, we will not be looking at the word outlook for the naira by looking at the borrowed exchange rate. But when you look at outlook based on what is at the interbank, which is today an average of about 198, like I read in my statement, I believe that given the pressure that we had seen in the market as a result in the drop in crude price, the pressures that have come, that adjusting the currency at the level of 198, I would say it's okay, and I still say it's sufficiently appropriate. But I think that the number of actions that will be taken going forward: one, deepen the market, improve supply into the market, and look at areas where demand pressures can be caught or demand inefficiency can be caught, and I'm sure in due course we will see the central bank will begin to take actions that will look at areas where people make demand, one, that is not effective, demand that we think is not useful for the economy. We will try as much as possible to control those, to ensure that when we look at the interplay between demand and supply, effectively what we will begin to see will be some gradual appreciation in the currency. I'm very optimistic that the foreign investors themselves, or foreign or domestic investors, they are looking at the currency, and optimistic that after the election, confidence will improve, because we have said it before, the elections will come, elections will go, Nigeria will remain the same, and business will continue as usual. I am optimistic that confidence will grow after the election, and then business will resume. And as we continue to take a view on the crude prices, I'm optimistic that the economy will remain resilient and will be in the upward direction. Reserves are $30 billion right now. Given the pressures and vulnerabilities that we have seen in the last couple of weeks, I think I will say is still a good level of reserve and can support at least close to about 5 to 6 months imports, and we believe that this is still good enough to support business and support the Nigerian economy. Interest rate outlook. The stance for now remains tight, and we will continue to monitor the liquidity in the system. And as we monitor the liquidity in the system, particularly during this election season, in the course of time, the CBN will be taking certain actions. We don't know what it will be, but it depends on the size of the liquidity and how we'll see the rate at which people use liquidity, either to target the real sectors of the economy, or whether they use them in what I call the unholy attitude of attacking the currency. Depending on the direction that we see people begin to move, we would react appropriately. But I think interest rate outlook for now still remains tight in the main. How does CBN intend to keep the reserve robust? Naturally, you will expect that the central bank will comment that there is a need for us to continue to imbibe fiscal discipline, and as much as possible see whatever can be done to build the excess crude account. But from our side, at the Central Bank of Nigeria, we are going to be taking certain actions that will nip the demand, some of the I use the word unneeded demand that is not useful. People, you heard about the incidence of some partial dollarization of the economy. We will take actions to prevent that. The currency for doing business in Nigeria remains the naira, and we will be looking at areas where people are making demand of foreign currency. People who are landlords that are asking for rent in dollars, schools that are asking for school fees in dollars, or transacting business in dollars is illegal in Nigeria, and we would like to advise those who are involved in these practices to please desist from them, because CBN will very soon and in due course come after them. Thank you. You talked about the Development Bank of Nigeria. Yeah, the Development Bank of Nigeria is a wholesale development bank in Nigeria, and it is meant truly as a development bank to support the transformation agenda of the government, as well as the development, I would say development banking focus of the Central Bank of Nigeria as well. We do believe that there is need for people, when they come out of school, they are not asking for jobs. They are only asking for an opportunity for them to access cheap finance, either small, micro, small or medium enterprises, or even those that are managing large businesses. They seek an opportunity to raise finance at concessionary pricing. And that is what the establishment of the Development Bank of Nigeria will afford people who want to do business. And together with all the initiatives that the Central Bank of Nigeria has come along with in collaboration with deposit money banks, we are very hopeful that with the size of liquidity that will be in the market at concessionary prices to support both the priority sectors or the real sectors of the economy, as well as the micro, small and medium enterprises, the nation will eventually achieve its goal of inclusive growth and job creation for our people. Thank you. Any more questions?
One more.
Let him ask.
Okay.
My name is Godwin. I work for Premium Time. In your speech, you spoke about the high cost of food importation. But my concern has to do with the high import duty that has to do with petroleum products. Despite the fact that CBN is come up with a lot of policies to restrain that, they will still hear of stories of marketers saying that they have not been able to get their LTs to import. And we see the fuel queues coming intermittently into the town. How does CBN hope to intervene to bring down maybe the attack on the production of petroleum products?
Well, let me correct the impression. There is no marketer today that will say that he has not been able to access foreign exchange for LCs. All their requests of foreign exchange for LCs to import petroleum products are being met. You talked about high cost of food. I do not agree with you. Indeed, the surveys of food prices that have been conducted shows that food prices have not gone up. If at all they did, they are, I use the word extremely marginal increase in food prices. You can go to the market today. I will use the word main staple foods. In December, which was on the Christmas season, the price of rice or beans or gari or cassava never went up, and you can go back and go and check the Bureau of Statistics information. You will find out that food prices have been stable, and it is as a result of the fact that we have seen improved domestic production of food in the country. We've seen increased production of rice, we've seen increased production of beans and cassava and gari-related products. So I do not agree with you. You don't have to agree with me. Go to the National Bureau of Statistics. You will find the information. It is clear for everybody to see that the food prices are still, for now, still remain stable. Thank you.
Any more questions?
Thank you.